Most investors think silver's big move is months away, maybe later in 2025, maybe 2026. They're wrong. The catalysts are aligning right now. The technical pattern is 95% complete. The supply squeeze is already happening in physical markets. And the timeline for the major move isn't months, it's weeks, possibly days. The signs are everywhere if you know where to look. Commercial shorts at record lows, physical premiums spiking, COMEX inventory collapsing, China's export data showing massive supply disruption, March delivery month approaching with elevated demand. These aren't future developments. These are current realities happening right now. The major move everyone thinks is distant is actually much closer than anyone realizes. And missing it by days could mean missing the entire first leg. Let me show you exactly why the major move is much closer than the market realizes, starting with the technical setup, because this tells you when, not just if, the breakout happens. Silver is currently in the final phase of a symmetrical triangle that began forming in early January. The triangle is created by connecting the lower highs and higher lows over the past 7 weeks. The upper trend line starts at $34.20 and slopes downward. The lower trend line starts at $32.35 and slopes upward. These trend lines are converging toward an apex. The apex, where the trend lines meet, is March 7th. That's 12 trading days away. Symmetrical triangles typically break before reaching the apex, usually when price is 75 to 90% of the way through the pattern. We're currently at day 35 of what will be approximately a 47-day pattern. That's 74% complete. Historical data on silver triangles shows that breakouts occur on average at the 82% completion point. That would be day 39 of the pattern, which is March 3rd. That's 8 trading days away. This isn't speculation. This is pattern recognition with statistical backing. Silver triangles don't stay compressed forever. They resolve. And based on the timeline, resolution is measured in days, not weeks or months. Now look at the volume pattern, because this confirms the triangle is nearing resolution. Volume has been declining steadily as the triangle compresses. Average daily volume was 72,000 contracts in early January. It's now down to 41,000 contracts. That's a 43% decline in volume as the range tightens. Declining volume during triangle formation is textbook behavior. It shows participation drying up as traders wait for the breakout to confirm direction. But here's the key. Volume decline accelerates in the final days before breakout. In the past week, volume has averaged only 38,000 contracts. That's the lowest weekly average in 9 months. When volume hits extreme lows like this during triangle compression, breakout typically follows within 5 to 10 trading days. We're in that window right now. Volume is at extremes. The pattern is 74% complete. The apex is 12 days away. All the statistical indicators point to breakout in the next 5 to 10 days. Let me show you the Bollinger Band behavior, because this adds another layer of confirmation. Bandwidth, which measures the distance between the upper and lower bands, has collapsed to 1.4%. That's the lowest reading since May 2024. When bandwidth drops below 1.5% in silver, historical data shows that a volatility expansion of 200–300% follows within 30 days. We're at 1.4% now. That means we should expect bandwidth to expand to 4.2% to 5.6% over the next month. But here's what matters for timing. The expansion doesn't happen gradually over 30 days. It happens suddenly within the first 7 to 10 days and then sustains. So the major move that creates the bandwidth expansion is likely to begin within the next week. The squeeze momentum indicator confirms this timeline. Silver just triggered a squeeze firing signal 2 days ago. This indicates the compression phase is ending and expansion is beginning. Historical squeeze signals in silver have led to 10% plus moves within 15 trading days with 83% accuracy. That puts the major move timeline at within the next 3 weeks. But the biggest portion of those moves, typically 60–70% of the total gain, happens in the first week after the signal. So the next 5-7 trading days are critical. Now let me show you what's happening with the catalysts, because technical timing alone isn't enough. You need fundamental catalysts to trigger the breakout. And those catalysts are converging right now, not in the distant future. First catalyst is the March COMEX delivery month, which starts with first notice day on February 28th. That's 6 trading days away. We're already seeing pre-positioning that suggests delivery demand will be elevated. Deliverable long positions, which are contracts held by parties eligible to take delivery, are running 42% above the February average. This pre-positioning typically indicates actual delivery intentions, not just speculative positioning. If March delivery demand comes in at 3,000 plus contracts, which the pre-positioning suggests is likely, that's 15 million ounces against registered inventory of only 42.1 million ounces. A single delivery month consuming 36% of registered inventory would create immediate stress and force repricing. The timing matters. First notice day is February 28th. Heavy delivery activity typically concentrates in the first week of the delivery month, so by March 7th, we'll know if delivery stress is real. That's the same time frame as the triangle apex and volume exhaustion. Second catalyst is China's February export data, which releases on March 8th. This will be the first full month of data showing the impact of China's export restrictions that went into effect January 15th, with full enforcement starting February 1st. Early indications suggest China's silver exports in February will be down 60-70% year over year. If the official data confirms this, it validates that 50-70 million ounces of annual supply has been removed from global markets. That's a game-changing fundamental shift that would force immediate repricing. The timing again aligns. March 8th is 13 trading days away, right in the window of technical breakout timing, triangle resolution, and delivery month stress. Third catalyst is the Federal Reserve's next meeting on March 18-19. While that's slightly beyond the immediate triangle breakout window, the anticipation and positioning ahead of that meeting starts now. If the market begins pricing in earlier rate cuts, or if economic data before the meeting shows weakness, precious metals rally ahead of the announcement. The major move everyone thinks is months away is actually being triggered by catalysts that hit within the next 2 weeks. Triangle resolution in 8 to 12 days. March delivery stress in 6 to 15 days. China export data in 13 days. Now let me show you the positioning data that reveals how unprepared the market is for an imminent major move, because this is what creates the explosive potential. When a move happens that the market isn't positioned for, the scramble to adjust creates momentum. Look at the options market positioning. The put-call ratio for silver options is currently 0.52. That means there are 1.92 call contracts for every put contract. That sounds bullish until you look at the strike distribution. Of the total call open interest, 68% is concentrated in strikes $36 and above. These are strikes that are 9% or more out of the money. Most option holders are positioned for a move, but they're positioned for a move that happens gradually over months, not explosively over days. If silver breaks out in the next week and runs to $35, $36 quickly, most of those out-of-the-money calls won't benefit much yet. Their holders will scramble to buy closer to the money strikes or buy futures directly to capture the move. That creates additional buying pressure that accelerates the rally. The implied volatility surface shows similar unpreparedness. At-the-money options have implied volatility of 22%, but 1-month implied volatility is only 19%. The market is pricing in less volatility over the next month than over longer periods. This is backwards. If the market expected an imminent major move, near-term IV would be higher than longer-term IV. The current structure tells you the market thinks nothing significant happens in the next 30 days. When the move happens anyway, Implied volatility will spike from 19% to potentially 35–40%, making all options more expensive and forcing option sellers to cover. The futures positioning shows similar complacency. Speculative long positions are at 3-month highs, which sounds like the market is prepared. But look at the average holding period. It's currently 14 days. That means most longs are short-term traders who will exit quickly on any volatility. If the breakout happens suddenly, these short-term longs will take quick profits at $34.50 or $35, creating selling pressure that the market will interpret as resistance. But that selling will be absorbed by longer-term buyers who recognize the fundamental story, and price will push through after a brief pause. This pattern of short-term profit-taking followed by continuation is what creates the stepwise rallies that catch traders off guard. They sell at $35 thinking they captured the move, only to watch silver run to $38 without them. Let me show you what retail positioning looks like, because this is the group most unprepared for an imminent move. The average retail investor doesn't follow commitment of traders' reports. They don't track COMEX inventory daily. They don't analyze Chinese export data. Retail knows that gold is at all-time highs. Some know that silver has lagged, but they think the silver catch-up trade is a future opportunity, not an immediate one. They're waiting for confirmation, waiting for the breakout to be obvious, waiting for media coverage. By the time retail gets those confirmation signals, silver will already be at $36–38. The first leg of the major move will be complete, and retail will be buying what institutional money accumulated at $32–33. The search trend data confirms this. Google searches for buy silver are at 6-month lows. YouTube views for silver content are down 34% compared to December. Social media mentions of silver are at baseline levels. Retail interest is dormant. This dormancy is what creates explosive moves when they're triggered. If retail was already engaged, already buying, already positioned, the move would be gradual as demand is already flowing into the market. But with retail asleep, when the move starts, it starts from a base of minimal participation and accelerates as retail wakes up. Now look at institutional positioning through the 13F filings from Q4 2024. Major hedge funds reduced silver exposure in Q4. Bridgewater cut silver holdings by 18%. Renaissance Technologies reduced by 23%. These are the biggest algorithmic and macro funds, and they lightened up on silver. Why? Because Q4 saw gold rallying to new highs while silver lagged. The relative performance favored gold, so institutions rotated from silver to gold to chase the stronger performer. But that rotation is setting up the opposite move now. These same institutions will rotate back into silver when it starts outperforming. They'll chase the new momentum, and because they're large, their rotation will accelerate the move. The ETF holdings show similar patterns. Total silver ETF holdings declined by 42 million ounces in Q4 2024. That's 3.2% of total ETF inventory. Investors were exiting or reducing positions during the lag period. But look at what happened in early February. ETF holdings stabilized and started showing small inflows. In the past 3 weeks, total holdings increased by 4.8 million ounces. The tide is turning. But most investors don't realize it yet because they're looking at headlines from Q4, not current data from February. The commercials, as we discussed, have covered 110 million ounces of shorts. But here's what's interesting. The pace of covering accelerated dramatically in the past 2 weeks. They covered 8,000 contracts in just the last reporting period. That's 40 million ounces in 1 week. Why the acceleration? Because they can see the same catalysts converging that we're discussing. March delivery approaching, China data imminent, technical pattern completing. They're covering aggressively because they realize the major move is close, not distant. When the smart money is rushing to cover shorts while retail sleeps and institutions are underpositioned, you have the setup for an explosive move that catches almost everyone unprepared. Let me show you the physical market signals that indicate the major move is imminent, because while paper markets can be manipulated or delayed, physical market stress eventually forces repricing regardless of positioning or sentiment. Dealer inventories in the United States have reached critically low levels. Major dealers are reporting that wholesale 1,000-ounce bar availability is the tightest it's been since the 2021 shortage. When you place large orders now, you're getting quoted 4 to 6 week delivery times instead of the normal 1-2 weeks. This isn't seasonal. February isn't a peak demand month for precious metals. Tax refund season hasn't started yet. There's no holiday buying. This is baseline demand overwhelming available supply. And if this is happening in February, imagine what happens when seasonal demand picks up in March-April. The premium structure is sending urgent signals. Not just that premiums are high, but that they're diverging across products in ways that indicate genuine shortage rather than just elevated demand. American Silver Eagles at $6.80 premium is high. But what's more telling is that generic rounds, which normally trade at $2-3 under Eagle premiums, are now only $2.60 under at $4.20 premium. The spread has compressed from $3.50-$4.50 to just $2.60. When premium spreads compress, it means buyers are less picky about which product they get. They just want silver, any silver. That's shortage mentality, not preference shopping. And it indicates the physical stress is real and accelerating. The Mint production data confirms supply stress. The U.S. Mint announced allocation limits on Silver Eagles for March delivery. They're rationing supply to dealers because they can't produce enough to meet demand, even running at capacity. Royal Canadian Mint reported similar constraints. Perth Mint has extended lead times to 5 to 6 weeks for some products. The Austrian Mint is prioritizing domestic orders over international shipments. Global minting capacity is maxed out and still can't keep up. This production stress means that even if silver prices spike 20 to 30%, new supply can't flood the market to cap the rally. The mints are already at capacity. They can't produce more. So price has to rise enough to ration demand, not just incentivize supply. Let me show you what's happening in the lease markets, because this is where you see institutional-level stress. 1-month silver lease rates jumped from 2.1% to 3.8% over the past week. That's an 81% increase in the cost to borrow silver for 1 month. Lease rates spike when there's competition to borrow silver. Who borrows silver? Industrial users who need it for production. Short sellers who need to deliver against their positions. Arbitrage traders who need metal to complete their strategies. When all three groups are competing for the same limited borrowable supply, rates spike. And rates spiking in the near-term tenors, 1 month and 3 month, while longer tenors remain stable indicates immediate stress, not long-term concerns. This near-term stress suggests that within the next 30 days, there will be delivery or production demands that can't be met at current prices. The lease market is pricing in a squeeze, and squeezes happen fast when they happen. The COMEX warehouse movements tell the same story. Over the past 5 trading days, registered inventory declined by 2.8 million ounces. That's 560,000 ounces per day leaving the system. At that rate, registered inventory hits 30 million ounces in 21 trading days. Below 30 million ounces, with open interest at 184,000 contracts, you're at a 30.7 to 1 ratio. That's critical territory where the exchange loses credibility. And the market knows that threshold. So there's incentive for anyone holding short positions to cover before inventory reaches that level. This creates a deadline effect. Shorts need to cover in the next 15-20 trading days before the ratio becomes untenable. That concentrated covering within a specific time frame is what causes vertical price moves. Now look at the Shanghai premium. Silver in Shanghai is trading at a 0.85 premium to London silver. That's the widest premium in 8 months. It indicates Chinese buyers are willing to pay significantly more than global prices to secure metal. Why? Because they can't import it easily anymore due to the export restrictions. So they're bidding up domestic supply. But this creates arbitrage incentives. If you can get metal into China, you can profit from the 0.85 premium. The problem is, getting metal into China is hard now due to the restrictions. So the premium persists. And it signals that when Chinese restrictions eventually ease, or when international supply becomes available, there will be massive demand from Chinese buyers who have been unable to source metal. The backwardation in the spot to futures spread is another critical signal. Spot silver is trading at a 0.08 premium to front-month futures. This is mild backwardation, but it's backwardation nonetheless. Normal market structure is contango, where futures trade at premiums to spot due to carrying costs. Backwardation indicates immediate demand exceeding immediate supply. People want metal now, not in the future. They're willing to pay premiums for immediate delivery versus waiting for deferred contracts. This is classic shortage behavior. When physical premiums are spiking, lease rates are spiking, inventory is collapsing, mints are rationing, and the spot futures curve shows backwardation, you're not looking at a shortage that might develop in 6 months. You're looking at a shortage that's happening now and will force repricing imminently. Now let me show you the exact price path the major move is likely to follow, because understanding the likely sequence helps you position appropriately and avoid getting shaken out during normal volatility within the larger move. Phase 1 is the initial breakout above 33.85. This is the triangle resistance and the level that's capped silver for 7 weeks. When this breaks on volume above 65,000 contracts, it confirms the major move has started. Target for Phase 1 is $35.20, which is the next significant resistance level. This phase typically takes 3-5 trading days and produces 4-6% gains. It's fast enough to catch people off guard, but not so fast that it triggers immediate profit-taking from long-term holders. This is the stealth phase of the major move where it's happening but not obvious yet to retail. Phase 2 is the consolidation after the initial breakout. Silver will likely pull back from the $35-$20 area to around $34.20, $34.50. This shakeout tests the conviction of those who bought the breakout. Weak hands sell, strong hands hold or add. This phase typically lasts 2 to 4 trading days. Volume declines. Momentum appears to be fading. Media coverage, if any exists at this point, questions whether the breakout is real. This is where most retail investors who tried to time the breakout get stopped out. But this consolidation is healthy. It sets the base for Phase 3. And traders who understand the pattern use this pullback to add to positions before the acceleration phase. Phase 3 is the acceleration. This is when silver breaks above the consolidation highs around $35.50 and runs to $38-39. This phase is driven by FOMO, short covering, and institutional repositioning. The move that seemed to stall in Phase 2 suddenly explodes higher. This phase typically takes 5 to 8 trading days and produces 8 to 12% gains. Volume expands dramatically. Media coverage picks up. Retail investors who sat out phases 1 and 2 rush in. Momentum algorithms trigger. This is where the major move becomes obvious to everyone. Phase 4 is the extension to $42-44. This phase is driven by fundamental recognition. By this point, the narrative has shifted from silver is consolidating to silver is in a bull market driven by supply shortage. Investment demand surges. ETF inflows accelerate. Mining stocks go parabolic. This phase can last 10 to 15 trading days and produces another 10 to 15% gains. But it's also where volatility increases. Intraday swings of $1-2 become common. Pullbacks of 3 to 5% happen and get bought aggressively. This tests the nerves of even experienced traders. The total move from current levels around $33 to the Phase 4 target of $42-44 represents a 27% 33% gain. The timeline from initial breakout to phase 4 peak is roughly 32 trading days. That's 4 to 6 weeks calendar time. Most investors think a 30% move in silver takes 6 to 12 months. They're not prepared for it to happen in 4 to 6 weeks. That's why the major move is closer than people realize, not just in days to start, but in total duration. Now let me show you the specific trading strategy for each phase, because knowing what's likely to happen doesn't help if you don't have a plan to capitalize on it. Before phase 1, right now, establish 60% of your intended position. Entry anywhere from $32.80 to $33.20 is acceptable. Stop loss at $32.20. This gives you $0.60 to $1.00 risk per position. When phase 1 breakout happens above $33.85, add 25% more to your position. Don't wait for a pullback. The breakout is the confirmation signal. You're buying strength, which feels wrong psychologically but is correct strategically. During phase 2 consolidation, if price pulls back to $34.20, $34.50, add your final 15% of position. This final add takes advantage of the shakeout while maintaining the conviction that the major move is underway. Take first profits at $37, $38. Sell 25% of total position. This locks in gains and ensures you don't give back profits if the move stalls earlier than expected. Your stop on remaining position moves to $35.50, which is break-even or small profit depending on your average entry. Take second profits at $41 to $42. Sell another 30 to 35% of position. Now you've taken back more than your initial capital and you're playing with pure profit on the remainder. Let final 40-45% run with a trailing stop of $2 below the highest close. If silver reaches $44, your stop is at $42. If it reaches $48, your stop is at $46. This lets you participate in any extension beyond the expected targets while protecting accumulated gains. The risk management is critical. If silver breaks below $32.20 before the breakout happens, the entire thesis is invalidated. Exit all positions immediately. The major move either isn't happening or is delayed beyond the immediate time frame. This scenario has roughly 15% probability based on current technical and fundamental setup. But 15% isn't zero. Managing that downside risk is what separates professional trading from gambling. Let me address the biggest mistake investors make when major moves happen faster than expected. They don't believe it. They think it's a false breakout. They wait for confirmation. They want to see media coverage. They want friends to validate their analysis. By the time they get all that confirmation, phase 3 is complete, and they're buying at $38 what they could have bought at $33. Then, when the natural phase 4 volatility hits, they panic and sell at $36, locking in a loss. The major move is closer than you realize. The technical pattern completes in 8 to 12 days. The catalysts hit within 2 weeks. The physical market stress is already forcing repricing, and the timeline from breakout to peak is 4 to 6 weeks, not months. This is your warning. Position now or chase later. Those are the only two options when major moves happen on compressed timelines.